Good morning. I'm Jen Amos at Weiss Research.
I'm Andy Myers, and this is your morning market update for Friday, July 8th. We're seeing a violent reaction in the global markets following another extremely weak month of job growth. The U.S. economy added just 18,000 non-farm payrolls in June, and the reading for May was revised down by more than half to 25,000. Economists had been predicting an increase of well over 100,000 jobs last month. Meanwhile, the unemployment rate ticked up to 9.2%, its highest level since December. Economists had expected unemployment to hold steady. The report suggests that the sudden slowdown in the economy may be more long-lasting and severe than feared, and it even raises concerns about a double-dip recession. It could also create a tough decision for the Federal Reserve. The central bank recently ended QE2, its $600 billion bond buying program, despite signs of a slowdown, and said no new monetary easing was needed.
Not surprisingly, U.S. stocks opened sharply lower following the data, and the European markets gave up their earlier gains. But the report is also having a major impact on the other asset markets. It's causing investors to rush to perceived safety, and that means big gains in Treasury prices and declines in yields. The yield on the 10-year note is falling closer to 3%, and the 2-year note is now yielding 0.4%. Meanwhile, the U.S. dollar is giving back some of its earlier gains, but gold is benefiting from its status as a hard currency, rising to above $1,540 an ounce. But oil prices are suffering on expectations that a slowdown in the U.S. economy will cut into demand from the world's largest energy consumer. Light sweet crude had been trading close to $99 a barrel ahead of the employment report, but it's now dropping back around $97.
The report is causing weakness across all sectors of the stock market, but among the hardest hit are financial stocks. Right now, Bank of America, Citigroup, and Wells Fargo are all dropping more than 1%. Meanwhile, Goldman Sachs is down about 1%, following another cut in its second quarter earnings estimate by Oppenheimer. And Morgan Stanley is losing nearly 2% after Ticonderoga cut its price target on that stock. Another decliner in early trading is Google. It's sliding 2.5%. After a stock downgrade from Morgan Stanley. The analyst cut Google from overweight to equal weight, lowered his price target on the stock from $645 to $600 a share, and slashed his estimate for 2012 earnings per share. The call was based on Google's aggressive spending on hiring, compensation costs, and advertising, which have uncertain return on investment.
We do have some positive corporate news to tell you about this morning. Southwest Airlines reported that its total traffic in June rose 7.5%. The percentage of available seats filled with passengers also rose to nearly 84%, from just under 83% a year ago. And finally, keep an eye on shares of TJX. The discount retailer reported much stronger than expected June same-store sales yesterday, prompting both Ticonderoga and Citigroup to upgrade the stock. Citi now has a hold rating on TJX, while Ticonderoga calls it a buy. That's the latest from Weiss Research. Have a great trading day and a fabulous weekend.